Dear friends, please come to the next chapter called credit derivatives. This is another complex derivative product used by companies either to hedge the risk either to hedge the risk, or they can use for speculation also. So we'll see one by one the concept of credit derivative, credit and derivative. Okay, two terms are there. So this is a company, let us call it life insurance company. Let us call it life insurance company or any such company. They have taken insurance premium from large number of people, and if there is any problem, they have to compensate. If the risk occurs, they have to compensate. So they have to keep that fund safely. So they would invest in some corporate bond. So this is a company X which have issued corporate bond or debenture. So LIC would invest in this corporate bond, but corporate bonds are risky. Corporate bonds are risky. There can be default. Am I right? There can be default. So what they do? They go to another entity and they tell that I want to ensure that I don't lose money on this corporate bond, because if that company fails, I might lose my money, and they enter into a agreement with this, let us call it investment bank, that please ensure that I don't lose my money. So indirectly what they are saying, please insure me against the risk of loss. So this investment bank will create a derivative. If you lose money, we'll pay you. But then I am giving you this protection. You have to pay me some premium. So this derivative product, which you can understand, is a form of assurance given to this company that in case if company X defaults, we will make you the payment. Otherwise, no problem. By paying that premium, you ensure that if there is any default, and the amount involved is huge. Suppose you invested 100 crore. There is a big risk if company X goes bankrupt. If company X default, LIC would lose that 100 crore, which is public money, insured people money. Lot of people have faith in that company, so they won't be able to repay. So therefore, they get their credit risk. Can I say like this? They get their credit risk insured by another agency. Let us call it investment bank, and for that, this product that they use for hedging the credit risk is credit derivative. Okay, so that was a small background of why this chapter credit derivative is introduced, because many companies are exposed to this credit risk. It is not just the market risk where the market price will change. In day-to-day life, we are exposed to credit risk. Counterparty may default. Counterparty may not pay you on time. Counterparty may not pay at all, and you will lose your money. Is there any way to protect ourselves from this? The answer is yes. You can protect yourself from this by having a credit derivative. So here also we have somebody who wants to enter into a credit derivative, wants to buy, somebody wants to sell also. Okay, so very interesting discussion, and they can be used for speculation also. And because they are used for speculation also, they are very risky instrument sometimes. In US financial crisis, which we discussed in earlier chapters also, one of the major reasons was this excessive use of, too much use of credit derivative. Okay, it was not just used for hedging, it was used for speculation. And once you start using it for speculation, then the risk multiplies. And derivative market, as Warren Buffett had said, derivatives are weapons of mass financial destruction. If there is something going wrong, it can spread so fast that it can collapse your entire financial system, which we have demonstrated in year 2008. Many of you may be young students at that time, but you can ask somebody senior, or you can read the books where this whole thing is explained. It was so difficult for the American economy to protect itself, and the government had to interfere. Government had to bail out certain big companies by giving them billions of dollars of funding. 700, 800 billions of dollar funding they had to give to protect certain big names in the US financial market, and it had spread across the globe also, because other countries are also linked with USA. Lakhs of people lost their jobs also. Many big banks in USA had to wind up. Okay, many big banks, Lehman Brothers, one of them, one of the biggest investment bankers in USA, because of this use of excessive derivative and credit derivative, they had to wind up. So that is for some later date. So credit derivative is, as the name suggests, is a sum of two terms, credit plus derivative. We have seen what is derivative. Derivative is an instrument which derives its value from an underlying, and that underlying can be anything. As long as the value of the underlying will fluctuate, you can create a derivative out of it, like stock, shares, currency, even interest rate. Okay, so you can create derivative on that. This credit derivative started in 1996 due to the need of the banking institution to hedge their exposure of lending portfolios. So who were the main player who started this concept of credit derivative? The banks, because banks have given loan. Imagine SBI given loan to, say, Adani Group. Thousands of crores of rupees are involved. What if there is a default? They don't repay the loan. So SBI will have a difficult time. SBI's depositors and investors will have a difficult time. So they get to insure this risk. They get to insure this credit risk. So there are companies who are willing to accept that risk for a price. So to reduce the risk of the banking system, this credit derivative was started in 1996, and today it is one of the structured finance product. Structured finance product means it is designed to meet the specific requirement, customized to meet the specific requirement. They are not traded on the exchange, but they can be customized to meet the requirement of the parties involved, like bank or a bond holder, person who has given loan to his friend. They can get the credit derivative and protect themselves from the risk. Financial products are subject to two types of risk. Financial products are subject to two types of risk. One is market risk, which we have seen. Market can change for so many reasons. Some of them may be unfavorable also, and you can't do anything about it. You really can't do anything about this market risk. It is called systematic risk. Stock market can suddenly change. There was a corona in year 2000 and the stock market, which was 41,000 points Sensex, in a week's time it has gone down to 25,000 points. So imagine how much risk was involved. From 25,000 it has moved to 67,000, 68,000, 69,000. So stock market can fluctuate. Something goes wrong in US economy, Indian stock market will change. Something goes wrong in Chinese market, Indian stock market will react. Similarly, the interest rate keeps changing because of so many reasons, like there may be inflation in the economy. To reduce the inflation, to curtail the inflation, the RBI may increase the interest rate. But interest rate increase can affect the value of the bonds, can affect the products whose valuation depends on the interest rates. In US economy, they are increasing the interest rate. Because of that, other economies are also increasing the interest rate, and that affects the valuation of financial products. Foreign exchange rate can also move adversely. From 70 rupees to 85 rupees in a short span possible. So imagine the value of your financial products which are in foreign currency, their values can change. Your loan liability can increase like anything. Okay, your debtors value can get affected. Your creditors value denominated in foreign currency can get affected. But there are financial derivatives. If you don't want to take that risk, there are financial derivatives like forward, future, options, swaps. They can be used to hedge the market risk. Market risk can be hedged by using financial derivative product, option, swap, future, forward. But there is another type of risk that you carry in your business is credit risk. Credit risk means the other party can default. I have given loan to a friend. I am carrying a credit risk. He is my friend, but he can default and I lose my money. I give you two examples. Insurance companies invest a lot of money in the corporate bonds, debentures. They give loan. They are exposed to the credit risk. Banks, the major institution who are exposed to the credit risk, is that the counterparty can default. This risk arises from non-fulfillment of the obligation by the counterparty. But are there standard derivative products to deal with credit risk? No. So to mitigate this credit risk, we thought, let us develop some product which will be useful for the lenders. Otherwise, lenders will rethink before lending money. But with the availability of credit derivative, now I don't mind lending. I don't mind lending because I can get my credit risk insured, or I can cover my credit risk using that credit derivative product. So here comes the role of credit derivative. Basically, derivatives designed to hedge the credit risk. Derivative designed to protect you from the risk that the counterparty can default. So you are protected in that case. Credit derivative is a mechanism whereby the risk is transferred from risk averse investor to those who wish to assume the risk. Simple. This is what derivative does. Derivative transfers the risk from the party who doesn't want to take the risk to the party who is willing to take the risk for a price. So credit derivative does that. Now the banks can give the loan and get themselves covered by using credit derivative. There are agencies who are willing to accept the credit risk of yours, they have their own set of calculation, they get a premium for that. Okay. So there are number of credit derivative products. We are going to discuss two types of credit derivative products. As we discussed that we are going to restrict ourselves to the boundaries of the syllabus. Although I will give you additional information, but the priority is that the syllabus must be thoroughly in detail completed. So there are many types of credit derivative product, but our syllabus says only read two very popular, and if you read these two, they are quite good enough. One is called collateralized debt obligation. Collateralized debt obligation, in short you will find CDO, very popularly called CDO. How does it work? We'll discuss. And very exotic product, credit default swap. Credit default swap, that means it is like an insurance which protects you from the default by the counterparty, and for that the writer will charge you some premium. Okay. So now next discussion is about CDO. So I will ask you to draw this diagram in the notebook, because my whole discussion will be based on this diagram, and all the discussion in the notes which institute has given is also based on this diagram. So please write it down. Collateralized debt obligation. Collateralized debt obligation. Collateralized debt obligation. So there is an originator, let us say a finance company. Originator can be like a finance company or a bank or an insurance or a pension fund, PF fund, okay, and they have invested in auto loan, home loan. So in their books they have all these assets which basically represents loan given to parties for purposes like auto loan, home loan, car loan, credit card risk, bonds. Then what do? They transfer this reference asset to another entity called special purpose vehicle, SPV. In short, we'll call it SPV, who is willing to assume the risk now. SP will pay cash and these assets are transferred to SPV along with the risk and all the rights to the cash flow. So this is somewhat similar to securitization. But it is little advanced version of securitization. Now what this SPV does? SP will create securities and sell the security to the investor. SP will create the securities, sell it to the investors. Depending upon the underlying asset, these securities will be divided into three categories, three tranches. They call it tranches. In the language of finance world, there are three tranches. One is called senior, second is called mezzanine, and third is called equity. Okay, that is called equity. Senior tranches means they comprise of highly rated instrument where the risk is low but the return is also low. Highly rated, low risk, low return. Those who don't want to take high risk can invest in senior rated instrument, and this is middle. Mezzanine means middle. Okay, more risky than equity, more risky than senior, but less risky than equity. So mezzanine means low rated instrument, but the yield is high. Credit rating is low, but the risk is high, so they get a high return also. So there are investors who would be willing to invest in the mezzanine portion, and then even a higher risk. The third tranche is called equity. They take very high risk, so they get very high yield also. They get very high risk, so they get very high yield also. So they are called equity or residual. It is also called residual. They are subordinate to everybody. If something goes wrong in this system, the first payment is made to senior category. After the senior holders, senior investors, senior category is paid off, then the payment is made to mezzanine category, and if something still remains, the payment would be made to equity category. So who is exposed to the residual risk, the highest risk? The equity. So investor invest in this instrument issued by the SPV. SPV gives it to the originator. This is how the cash moves. And whenever these loan assets make payment, these payments are made to these investors. So the investors enjoy the right to cash flow, but the investors also take the risk. The investors also take the risk. The investors also take the risk. This is how this CDO arrangement is done. This is a simple diagram of how the CDO arrangement is done. If you have drawn this diagram, kindly inform me, because if you have this diagram in front of you when we are discussing the note, you will be able to understand better. Have you drawn the diagram? Students, have you drawn the diagram? In the exam also, they will ask you this question. Write a note on CDO, then kindly draw the diagram also. Kindly draw the diagram also. Student has drawn the diagram, so we are going to move ahead. Now we'll draw a diagram for credit default swap. Credit default swap is like insuring your credit risk. So draw this diagram also. Credit default swap is a credit derivative to protect you from credit risk. Okay. So we have on the left side investor, protection buyer. So it can be, for example, SBI, LIC, Bajaj Finance, okay, Muthoot Finance, Mannapuram Finance, or anybody who has got credit risk. So mostly the companies which have lot of loans in their books, they would be interested in this derivative product. Reference assets are, for example, auto loan, home loan, and like this. Then there is a protection seller, that is the one who is willing to take your credit risk for a premium. Okay. So this investor or the buyer of the CDS, credit default swap, will make a premium payment to the protection seller. So that is like an insurance premium. For example, if the investor has given this auto loan for 15%, he will share, let's say, 2% to the protection seller. So protection seller is also smart. He will collect 2% from so many people for whom he writes this risk, and he knows that everybody is not going to default. This investor is also happy. By paying 2% out of 15%, it is risk free now. Suppose this auto loan is 2000 crore, and if it defaults, the protection seller will give him 2000 crore rupees. Okay, so there is an arrow which says payment on default. Payment on default. If suppose these people, the person who have taken loan, advance, credit, they don't pay, then the protection seller will make you the payment on default whenever the default event occurs. If the default event occurs, then the protection seller will make the payment of default, and all these asset now will be handed over to the protection seller, and then protection seller will dispose them in the market at whatever price. So this is how CDS works. Looks nice. Okay. Looks nice. The problem is, which I am going to explain later also, this person, protection seller, becomes very greedy. He thinks that, oh, this is a very smart way to earn money. I am getting 2% into 2000. Every year 40 crore I am earning from this one protection buyer. So this is a simple business model. I don't have to do anything. I just have to keep on insuring and keep on earning. So he will write more CDS. And a time comes, the total value of the CDS which he has written may become, say, 20,000 crore. But their capital employed may be only 1000 crore. On a capital base of 1000 crore, they have written 20,000 crore rupees and continuously enjoying money, 2%. So 2% of 20,000 if they have underwritten, so that is how much is that? 400 crore per annum. 400 crore they would be earning. Such a nice business model. But if something goes wrong, they do not have enough capital to make the payment. If 5 of the companies suppose ask for the payment, and let us say average ticket size is 400 crore, so 400 into 5, this protection seller will have to pay how much? 2000 crore. But they don't have that much asset, they don't have that much capital. Protection seller means basically insurance company. Okay, insurance company. And this has happened in USA. There was a big insurance company called AIG, which you have heard. One of the biggest insurance companies in the world, and they became too greedy. They started accepting this credit default swap because they know that this home loan is usually safe. What is the problem that can happen in home loan? There will be a default. If there is a default, you take the property, you sell the property in the market and you recover your money. So where is the risk? Even if this home loan buyer will default, I will get the home and I will sell it, so I don't have the risk. But then in USA, people found a mechanism to make profit. This fellow was also greedy, the investor was also greedy. The investor is giving loan to everybody. You are a cook? Yes sir, I am a cook. What is your salary? Sir, I earn $5,000 a month. How much loan do you need? I need $2 lakh loan for buying a house. The cook is earning $5,000 and the bank is giving him $2 lakh of loan, because bank also knows I will get the risk insured. So I don't have the risk. Some maid comes who works in houses, suppose salary is $6,000 a month, and she has taken a loan of $1,50,000. Bank is also thinking that, oh, what can go wrong? I will sell the house. Or bank has also taken the protection from this protection seller, and this way the banks in USA started lending money to every XYZ person who did not have the ability to repay. But then this bank is thinking, I don't have a problem, I'll get the credit risk insured, and even if it doesn't pay, I am safe. This protection writer, the insurance company, they also become greedy. They are thinking that I also don't have major problem. There is a house which is mortgaged. If the person doesn't pay, the house can be sold. So it went on for some time. And then this cook, this maid, the driver, and all such people who could not afford to pay those EMIs, they started defaulting. If they start defaulting, what will happen? The bank will take the possession of their house, give it to the protection writer, AIG company, and AIG company had to pay huge amount to the banks because they have written this CDS. Now see the problem. AIG is now having 20,000 house property with them. I am sure you are laughing at your home. Okay. Because every bank goes to AIG and says, you take this house property, take this collateral, and please pay me $1,50,000 which you have written, pay me $2 lakh. AIG is now has gone mad. It has got an inventory of 20,000 houses. What do I do? My business is not to sell houses. My business is to run insurance company. And to whom do I sell these houses? 20,000 houses. There is no buyer because the economy was in a difficult stage now. Continuous default is happening. And to sell 20,000 or 25,000 house is not a joke. So they had to sell the houses at 25% of the amount of the loan which was given against that house. So if the loan was 2 lakh, the house could be sold only for $40,000. If the loan was $5 lakh, the house could be sold only for $80,000. Some of the houses could not be sold also so easily, and there was a crisis. What if an insurance company fails to honor the contract? What if the insurance company fails to honor the contract? Tell me, if you have taken your car insurance or bike insurance and the insurance company says, sorry, I can't pay you the amount, I don't have money, your faith in the insurance system will collapse. Your faith in the banking system will collapse. These banks and these insurance companies, this derivative, they are a system. And if a system on which people trust will collapse, then there is going to be a massive crisis, and that is what happened in USA. Then the US government had to interfere, give money to AIG, okay, and then finally somehow over a period of time they could recover. It took so many years to recover from this. This was popularly called subprime crisis. Why it was popularly called subprime crisis? Because the loan was given to subprime people. Subprime people means those who cannot afford to repay that loan, but the loan was given because bank is greedy. Insurance company is greeting. Insurance company found it easy way to earn money. Bank says, I don't have any problem. I'll earn the interest. If it doesn't pay, I'll take the money from the protection. And the bank manager is greedy. His bonus is dependent on how many loan he has sanctioned during the month. The sales department are greedy because they also get some bonus commission based on how many loan they have sanctioned. That is why you see the bank officers are after your life. In afternoon 3 o'clock, sir, do you want a house loan? Sir, do you want a credit card? Because for every loan, every credit card they sell, they get some cut in that. Is it right? So everybody became greedy. The greed compounded infinitely, and because of that, the US economy had to face this problem. Warren Buffett was proved correct. He had said, derivatives are weapons of mass financial destruction. That quote I have given in your book also in some chapter. Okay, so now after that long story, which I am sure you would have enjoyed, come to CDO. Now come to exam. We are student of exam also. CDO is an advancement of securitization. Keep the two diagram in front of you and keep reading the notes, you will understand. Without the diagram, difficult to visualize. CDO is an advanced form of securitization, because in securitization also SPV purchases your loans and advances, issues securities. But this is much more complex than a securitization process. In securitization, the securities issued by SPV are backed by loans and receivable. The CDOs are backed by pool of bonds, asset-backed securities, REIT, Real Estate Investment Trust. REIT is Real Estate Investment Trust. That means here the underlying are bonds, ABS, asset-based securities, Real Estate Investment Trust, and the underlying can be other CDO also. The underlying can be another CDO. So this is a complex product, not as simple as securitization. And this is the basically the greed of human nature, and they create such complex product. Initially you don't know what can be the output, what can be the outcome, and accordingly it covers both collateralized bond obligation and it covers collateralized loan obligation also. So CDO includes bond obligation also and loan obligation. So CDO is CBO plus CLO. Collateralized debt obligation includes collateralized bond obligation and collateralized loan obligation. So types of CDO. The diagram which we had drawn was this one. Cash flow collateralized debt obligation. Look at the diagram. The cash flow collateralized debt obligation. The SPV will issue security to the investor. Investor will invest in the security issued by SPV. SP will make payment to the originator. And then there is synthetic collateralized debt obligation. All are explained below. Synthetic means here the collateralized debt obligation uses CDS, credit default swap. So this is even more complex product than the first one. So first type of CDO is cash flow CDO. Cash flow CDO is CDO which is backed by cash market debt or securities which normally have low risk weight. The answer is simple. You are an originator. This is an SPV. There was investors of different categories and you have given house loan. suppose risk is less. What if he defaults? If he defaults, we have his house as a collateral, okay, and therefore the risk is less. If something goes wrong also, the risk is less, which normally have low risk weight. The structure mainly relies on collateral's risk weight. This is house loan. The whole risk depends on this house, whether this house can be realized to pay off the securities. I'll repeat. Just a minute. This is SPV. These are the investors. Investor has invested cash here. That cash was paid to originator. Please don't mind the spelling. Now this SPV has issued securities to the investor, which are senior security, mezzanine, equity, according to the risk involved, different types of securities. This SPV is relying on this loan, house, collateral house. He thinks that if something goes wrong, I will repurchase the house, sell the house and make the payment to the investor. Therefore, this structure is less risky. Of course, if everybody defaults, like it happened in USA, then you will not be able to sell the houses also. Or even if you are able to sell, you have to give lot of discount on selling the house. The structure relies on collateral's risk weight and collateral's ability to generate sufficient cash to pay off the security issued by the SPV. The diagram which you have drawn in the notebook for CDO is the cash flow CDO diagram. Then there is synthetic collateral debt obligation. So what is the difference here? Difference between cash flow CDO and synthetic CDO is that instead of transferring the ownership of collateral to the SPV, that is a separate legal entity, synthetic CDOs are structured in such a manner that credit risk is transferred by the originator without the actual transfer of the asset. So here the actual transfer of the asset does not take place. Rather, in case of synthetic CDO, they enter into a CDS arrangement, credit default swap arrangement. Don't worry, SPV, don't worry. In case if something goes wrong, there is an insurance protection. There is an insurance protection, and therefore, even if the underlying does not pay, we will be able to pay you out of the money received from the insurance protection provider. That is how CDO is combined with CDS. Collateralized debt obligation is combined with credit default swap. Normally the structure resembles the hedge fund, where the portfolio of the CDO is dependent upon the value of the collateralized instrument, and the market value of CDOs depend upon the portfolio manager's ability to generate adequate cash and meeting the cash flow obligation in the timely manner. So CDOs are like hedge funds. There are fund managers, there are portfolio managers who has given this task of managing this whole collateralized debt obligation, and they get a huge commission for managing the CDO, and that is where the greed starts. When the incentive is linked to the volume or commission is linked to the volume, then people will try to increase the volume, and because of that they might take unnecessary extra risk also. While in cash CDO, collateral are moved away from the balance sheet, in synthetic CDO there is no actual transfer of asset, instead economic effect is transferred. So only the risk is transferred, asset is not transferred. This transfer of risk takes place by creating CDS or by issue of credit linked note, a form of liability. The structure is mainly used to hedge the risk rather than balance sheet funding. So the purpose of CDO is funding, whereas the purpose of CDS is risk hedging. The purpose of CDO is funding and the purpose of CDS is risk hedging. Let us see the cash CDO versus synthetic CDO. If there is a bank, the structure allows the customer relation to be unaffected. Okay. This is the bank. Let us say HDFC Bank. It has given housing loan. One option is CDO, where this housing loan will be transferred with the risk. But this will affect the relationship of the bank and the customer of the bank. Plus lot of administrative hassles will get involved. What is the administrative hassle? The customer of HDFC Bank will make payment to HDFC only. And HDFC will have to transfer that money to the SPV. But if you go for CDS, you are only taking insurance for credit risk. You are not transferring the housing loan to anybody. Housing loan remains in the books of the bank. The customer will make payment to the bank and the insurance company will make you payment only when the underlying defaults. If the underlying does not default, then things move smoothly as usual. This was started mainly by banks who want to hedge the credit risk but is not interested in taking administrative burden of sale of asset through securitization. Through securitization or CDO arrangement, the asset is transferred to SPV. Whenever the underlying receivable makes the payment, that is also transferred. So lot of accounting and administrative work will get involved if you transfer the asset through securitization route. But you can take the CDS and that will reduce your administrative headache. It will not affect your relationship with the client also. So technically speaking, synthetic CDO, which means the use of credit default swap, obtain regulatory capital relief benefit vis-a-vis cash CDO. So there is some regulatory benefit also in terms of capital management. There is some benefit of using synthetic CDO. So bank is also preferring synthetic CDO rather than cash CDO. They are more popular in European market due to reasons of less legal documentation requirement. Synthetic CDO more popular in European market, less regulation. Human beings don't like regulation. Next paragraph is types of synthetic CDO. Types of synthetic CDO. One is unfunded. It will be comprised only CDO. And then it is fully funded. It will be through issue of credit linked note. And partially funded, it will be partially through issue of credit linked note and partially through CDO. So these are the three types of synthetic CDO. One is unfunded, fully funded, partially funded. Unfunded only CDO. Fully funded, it will be through issue of credit linked notes or basically insurance. This is a kind of insurance. And some portion will be funded, some portion will be unfunded. Point number C, arbitrage CDO. The word arbitrage means you are trying to benefit because of the difference. Okay. In arbitrage CDO, the issuer captures the spread between the return realized collateral underlying the CDO and the cost of borrowing to purchase those collateral. So basically there are two amount. One is the cost of borrowing and return from collateral. Like the banking system does. They will borrow money, the issuer will borrow money at a lower rate, and the return from the underlying CDO or collateral will be high. So that is one advantage to the issuer of CDO. Difference between the rate at which they can borrow and the return they will generate on the collateral. This can be 6%, this can be 9%. So 3% they will earn because of the spread, and second, they also collect the fees for management of CDO. The arbitrage arises due to acquisition of relatively high yielding security with large spread from the open market. The writer of the CDO or the issuer of the CDO, they earn huge return on asset acquired, and they pay low interest on borrowing. That difference is the spread, and that is where the issuer of the CDO makes profit. Write one more line from my side. Write one more line from my side also. The term arbitrage in arbitrage CDO, the term arbitrage in arbitrage CDO refers to the idea of exploiting price discrepancies or market inefficiencies. Refers to the idea of exploiting price discrepancies or market inefficiencies. Because in the market, there are people who are willing to invest at a low rate of interest. There are people who are willing to borrow at a high rate of interest, and these two people, they don't know each other. So here this issuer of CDOs take the benefit of that market inefficiency and tries to earn that spread. Next point is risk involved in CDO. Okay, CDOs are structured product, and just like other financial products, they are subject to various types of risk. As usual, I have given you the long story of American 2008 crisis. One of the risk is that the underlying will default, that is credit risk. The person who has taken housing loan, they can default. The person who has taken auto loan, they can default. The person who has taken credit card, they will default. And then you may not be able to realize the security to pay all the investors. The prime sufferers of this type of risk are equity or junior tranche in the waterfall. There are three investors in SPV. Look at your diagram: senior, mezzanine, and equity. If default occurs, suppose the loan amount is 10 crore, but the asset realized only 2 crore, 8 crore loss. So those who invested in the senior bond, those who invested in that senior bond, they will get first their money. Let us say they have invested 1 crore, they will get it. those invested in mezzanine, they will get, suppose they also get 0.5. Remaining amount will be paid to this junior categories. Equity means junior. When it comes to payment, they are the last person in the queue, and therefore they will take the major hit. Okay, that is one risk. So when you are investing in such products, know your risk. And second risk is, as usual, interest rate risk, that is basis risk, and mainly arise due to different basis of the interest rates. So if the interest rate is floating rate and fixed rate, then this risk will arise, because the asset may be based on floating rate, but the liability may be based on fixed rate. So on the asset you may get lower interest, but to the liability you have to pay the same high rate of interest, and therefore this risk is also there. This risk is quite difficult to manage fully. Interest rate risk can be managed by using interest rate swap, which is our another chapter, interest rate risk management, or it can be managed by using cap, collar, floor to manage the interest rate risk. Assets are generating floating rate, liabilities are generating fixed rate, which means if the floating rate goes down, your interest income will fall, but the interest expense will be constant. So that is interest rate risk, and you can hedge it by using interest rate swap, cap, collar, floor. That will be covered in interest rate risk management. Third is your liquidity risk. Liquidity risk is there may be a mismatch in the coupon receipt and payment. Look at your diagram. You have SPV here, you have investor here, and you had originator here. Originator has transferred the housing loan, auto loan to this SPV. SPV will receive cash flow from this underlying asset. SPV has to make payment to investors. The problem can be the timing of receipt of cash flow and the amount of cash flow may not match with the timing and amount of cash payment to be made to the investor. So therefore there can be some liquidity issue in this case. Okay, they may pay, for example, by a bullet payment. Bullet payment means on maturity. Here we have to pay in the form of EMI. So that may result into liquidity mismatch. Another challenge is prepayment risk. Prepayment risk means the underlying loan, underlying auto loan, they may come and pay you the amount immediately. They say, yesterday I won a lottery, now I don't need a loan, so I want to prepayment my loan. Just an example. But what will that SPV do? SPV will have to keep that cash flow with itself. It cannot repay the investor. So this risk arises when assets are subject to fixed rate of interest and debtors have a call option. Call option means the borrower can redeem the bond before maturity. In this case, and this will usually happen when the market interest rate fall. When the market interest rate will fall, the borrower will repay a loan at a high rate of interest and go to the market and take the loan at a low rate of interest. So this is my SPV, for example. In your book I have drawn this diagram. This customer comes and he repays 100 crore to SPV, prepayment before maturity. But SPV will not be able to pay investor immediately. SP will have to deploy this 100 crore again. Usually prepayment takes place when the market rate has gone down. When the market rate has gone down, and therefore this SP will have that prepayment risk. Next is reinvestment risk. Reinvestment risk in the previous example only, if you get cash flow, then you may not be able to reinvest it at the same rate of interest. You may not be able to reinvest the proceed at the same rate of interest. That is reinvestment risk. And one more risk is called foreign exchange risk. Oh my God. If the underlying debts and loans are from foreign country, if the underlying borrower is from a foreign country, then the exchange risk is also there. Whenever he makes the payment, the exchange rate may fluctuate, and in that case there is a foreign exchange risk also. So these are some of the risk of CDO. So the one who manages the CDO, he is exposed to such risk. So we'll take a small break here, and after the break we'll discuss this next instrument called credit default swap. Okay, this credit default swap instrument was one of the important reasons for the 2008 financial crisis in USA. So let us take a small break. Please don't go away. Theory topics are also important. Yes, hello everyone, we are back. Have you also returned back? So next interesting credit derivative is called credit default swap. If you look at this term credit default swap, there are three terms they have used. So you would be interested in knowing why it is called credit default swap. Credit means the loan given. Like State Bank of India has given loan to a customer. There is a risk of default. There is a risk that the customer may default. So what you can do, this risk of default can be swapped with another party who is willing to take the risk from you for a consideration, that is premium or some form of amount they are going to charge. That is why this term is called credit default swap. Okay, so it is like an insurance, but not exactly an insurance. It is like an insurance because it protects the company from the risk of default on a debt or loan, debenture, bond, etc. Let us come back to this diagram printed in your or written in your notebook. There is a company which has given loans, different types of loan. They have a risk. This loan loan may not repay. They will default. Amount involved is large. They cannot afford to take such a large risk. But at the same time, they cannot shut down their business and say, because the loan involves risk, I will not give loan to the parties. So what is the way out? The way out is that there are protection seller. This person says, you don't worry, if there is any default by this home loan customer, auto loan customer, credit card customer, or on bonds and debenture where you have invested, we are going to make the payment to you on default. But then you will have to pay some premium to me. So how the premium is paid? It can be like this. To the home loan customer, you have given loan at 12%. To this protection seller, you will transfer 1%. You are happy. There is no risk now. Protection seller is happy. It is getting 1% income. And this protection seller will similarly write the risk of hundreds of customer, thousands of such customer, and will get 1%, 2% spread. So what a business model. The only problem will arise if there is a default event. If this loan customer, auto loan customer, they don't repay, there is a default event, and then you have to pay a huge amount to the investor, that is protection buyer, and this party, that is investor, will transfer that asset to protection seller will sell in the market. I give you the example of AIG company. They had got thousands and thousands of homes. What do I do with that? That will be the problem, but that is only if the problem magnifies a lot. So come back to your book again. I have tried to simplify to the extent possible. Under this arrangement, one party called buyer needing protection against the default. This is the buyer which requires protection against the default, pays a periodic payment to another party. So this is a periodic payment of premium called protection seller, who will take the default risk. So protection seller says, don't worry, you do your work. If there is a risk of default, I will take that risk. In case default takes place, there will be settlement. How the settlement will be there? Protection seller will make payment to this protection buyer, and protection buyer will transfer the reference asset to the protection seller, and if there is no default taking place, then enjoy. Cash flow, no cash flow will accrue to the buyer. So this is like an option contract. If nothing happens, nothing goes wrong, only your premium would be the loss. But if the default occurs, you will get the amount from the protection seller, and that is how credit default swap works. So it looks like an option. It looks like an option because if the default does not occur, you don't get any amount. But in case of option, there is a choice to exercise or not to exercise. Here there is no choice. Here there is no choice. If the default occurs, you will get the amount, which is not something which you have to exercise. Hence, it resembles more like a swap arrangement. You are paying for swapping your risk. Amount of premium depends on the price of underlying, especially when the credit risk is more. When the credit risk is more, for example, you are a company, let us say ABC Finance, and you have given loan to a company, let us say Theft and Burglary Limited. The name of the company to which you have given loan is Theft and Burglary Limited. High risk of default. Risk of default is high. The credit rating of this company is very poor. Credit rating of this company is very poor, and then you go to this protection seller or insurer or a bank, and you say that I want to hedge my credit risk here, the protection seller says, oh, there is serious risk involved. How much interest you are charging them? You say, I charging 18%. Protection seller will say, you will have to give me 5% because risk is very high. So therefore, when this underlying loan, advance, bonds, debenture have high risk, the premium will also be more. But if the underlying is suppose underlying or this advance is given, ABC Finance has given advance to, let us say, Reliance, AAA rating, then it will say, okay, I'll be happy with 1% premium also. So that is how this will work. Main feature of CDS. Paragraph next. CDS is a non-standardized private contract. I have told you these are not traded on the exchange. They are over-the-counter derivative products. Two parties will negotiate the terms and condition. So therefore, it is similar to forward contracts, because forward contracts are also non-standardized contract. They are not traded on the exchange and therefore they are free from the regulation of a governing body. If the instrument is traded on the exchange, then there are a lot of regulations of SEBI, stock exchange, etc. But because it's over the counter product, the regulations are less. So this buyer and this protection seller, they will decide the terms and condition of the contract. Point number 4. There is an International Swap and Derivative Association called ISAD. It publishes the guideline and general rules normally used to carry out the CDS contract. Because your syllabus has MCQ question also, then you will have to remember this basic detail. ISAD gives guideline on CDS contract. CDS can be purchased from third party to protect itself from the default of the borrower. Already explained several times today. Since an investor who is buying bonds from a company can purchase CDS to protect his investment from insolvency on the company. So basically CDS can be used for any credit risk, whether you have given loan or whether you invested in the bonds of a company where the risk of default is there, you can protect yourself from CDS. Using CDS, the level of confidence of the investor in bonds purchased increases. Okay, suppose you are Provident Fund Trust. You are not supposed to invest in highly risky security. But there is a company which has come out with a bond issue and it is paying 11% interest. But the rating is A. But you have a policy not to invest in something below AA. Then what do? I go to an insurance company or a protection seller like AIG. Okay. And AIG has a high rating in the market. AIG is high rating. AIG gives me credit default swap and says, don't worry, if this company defaults, we'll pay you. Now my confidence in this bond will increase because it is backed by AIG, who promises me to pay in case of default. For that, they may charge 1 or 2%. I am okay with that. Cost or premium of CDS has a positive relationship with the risk attached to the loan. So if you are investing in a bond with A rating, you may have to pay 1% premium. But if you are investing in a bond with B rating, C rating, BB rating, which is a sign of high risk, Here the premium to be paid can be 2 or 3% also. Higher the risk, higher will be the premium charged by the protection writer. Very simple. 60-year-old person has to pay more premium than 25-year-old person when he goes to take the insurance. So higher the risk, higher will be the premium or cost of the CDS. Is it understandable till now? Next is naked CDS. Oh, what is naked CDS? If an investor buys a CDS without being exposed to credit risk, it is called naked CDS. Oh, this is really interesting. There is a company, Thief Limited. It has issued bonds. Sorry, not AAA. B-rated bond. It has issued a B-rated bond. So the risk is very high. Risk is very high. This is a person whom we will call Mr. Smart. Mr. Smart. And then there is an insurance company whom we will call AIG. Mr. Smart, as the name suggests, he is smart. He knows that this company is going to default. He knows that this company is going to default. He is not investing in the bond of Thief Limited, okay? But he knows that, or he feels that this company may default. So he goes to the insurance company AIG, the protection seller, and says, I want to enter into a CDS contract with you, okay, which is equal to $10 billion, okay. AIG says, have you invested in that bond? You say, no, I have not. But still AIG thinks, I also don't have a problem. He says, you have to pay me 2% every year. You says, deal done. So 2% you have to pay to AIG as premium every year. You are betting on the possibility that Thief Limited will default. AIG, over smart company, this will call over smart. They will say, I have a very good business model, okay. For doing nothing, I am getting 2% of 10 billion as premium every year, and they are going to write it to more and more such parties and keep on receiving the premium. That is what insurance companies do. If Thief Limited does not default, it's okay. But in case Thief Limited defaults, AIG will have to pay to Mr. Smart $10 billion. So that can be a huge loss for AIG and a huge gain for Mr. Smart. Here Mr. Smart is using naked CDS. This CDS is naked. Why? Because Mr. Smart has not invested in the bonds or debenture of Thief Limited. He is only betting that Thief Limited will default. Okay. So this time this investor does not have any asset, but is only betting on the possibility of default, and for that it pays premium. In case the default event happens, you will get a huge amount. So it is just like you are betting on the possibility of a company defaulting, and there are people who are willing to give you insurance protection for that. If your bet is right, you will enjoy the profit. If your bet goes wrong, you will suffer. So that is about naked CDS. In USA, all these are very popular. They will keep a track of which company is likely to default, and they will enter into CDS contract for that company. Why CDS were designed? CDS were designed basically for hedging the risk. If you have a credit risk, you can transfer your credit risk to another party. That is hedging, and you can continue with your business. So it can be used by investors it can be used by bankers, it can be used by the lenders, so they can concentrate on their business, and the risk is protected by entering into a CDS contract with a protection seller. If the default occurs, you will get the payment from the protection seller. Next is arbitrage. Arbitrage means involving buying a CDS and entering into an asset swap arrangement also. And you will make profit because of the difference. For example, a fixed coupon payment of a bond is swapped against a floating interest stream. That is making use of arbitrage because of the price differential. And you are protecting yourself also from the risk. Then the third one, which the example of Mr. Smart I had given you, the example of theft and company I had given you, is that you can use it for speculation. And because of the excessive use of CDS for speculation, there was financial crisis in USA because people thought making a profit is so easy. AIG is thinking, wow, I'm just getting the insurance premium for doing nothing. And Mr. Smart is thinking, one day this company will wound up and therefore I'll be able to make a huge amount of profit. Okay. So that is how the speculator will make profit. If there is a default event, the speculator will make a huge amount of profit. And there are specialists who keep on studying the company's possibility of default and then they take a bet on that. Next is parties to the CDO. Who are the parties to the CDO? If you look at this diagram, you will understand the parties to the CDO is, there is a borrower who borrows funds from the investor. Is this diagram printed in the book? In the previous diagram, you can just add this part. I will highlight it, you can add this part in the previous diagram. Okay. You can add this in the previous diagram, or if you want to draw the full diagram, you can. So this person goes to the investor for borrowing money. Okay, let us say Vijay Mallya goes to State Bank of India for borrowing money. So borrower is Vijay Mallya, investor is State Bank of India. State Bank of India gives loan. Vijay Mallya issues bond or signs the loan agreement that yes, I have to pay, and the reference asset is auto loan, home loan, bond. Then this investor, the second party investor, he thinks that the risk is too high, so he goes to the protection seller. So parties are borrower, investor and protection seller. So buyer, second party is buyer. Buyer is investor, in our example SBI. Okay, he wants to protect himself from the risk. So if I look at this example, the first party is borrower here, second party is buyer, protection buyer, and third party is the protection seller. The third party is the protection seller. Is it right? Have you noted it down? Have you noted it down? And then there is a protection seller called writer. He takes the premium and he promises to pay in the event of default. He gets a regular payment from the buyer of the CDS. Have you understood with the help of diagram? If I would not have drawn the diagram, then you would have found it difficult to understand. A good student will draw the diagram and write in the exam also. Okay. Now next point is example. Suppose BB Corp buys CDS from SS Bank for the bonds amounting to $10 million of Danger Corp. So there is a BB Corp, there is SS Bank, and there is a Danger Corporation. So Danger Corporation is the borrower, BB Corp is the investor or protection buyer, and SS Bank is seller or writer, protection seller or writer. BB Corp will make premium payment to SS Bank. SS Bank pays on default. So BB Corp will make regular payment to SS Bank of premium. Every year they will pay some premium, and if the Danger Corporation defaults, suppose the default happens, SS Bank will make payment to BB Corporation, will receive one-time payment, and the CDS contract is terminated. So this is the diagram for this small story, like this one. In your book, you can mention in that previous diagram, the borrower is Danger Corp, the investor is BB Corp, and the protection seller is SS Bank. Remaining diagram remains the same. So this small example I have converted into a diagrammatic presentation. Okay, do you agree? If you agree, say yes, then I'll go to the next part. Yes, very good. Last part is settlement of CDS. CDS is a derivative. Derivatives are usually settled in two modes. One is called physical settlement and one is called cash settlement. In physical settlement, what will happen? In physical settlement, suppose the default occurs. If default occurs, and let us say the amount is $10 million, this is a Danger Corp, it has defaulted. So this protection seller, SS Bank, will make a payment of $10 million to BB Corp. And what this BB Corp will do, this loan given to Danger Corporation will be transferred to the protection seller, and then that protection seller will sell in the market at whatever value it can get. Is it right? But I, that is investor or buyer, I get full $10 million from the protection seller. So that is like physical settlement. I transfer the underlying asset, you give me the full value of that loan, $10 million. Understood? As I said, this diagram will be important for understanding the whole chapter. One diagram on the screen will help you to understand the whole chapter, and then there is something called cash settlement. In cash settlement, they are not going to make the full payment. They are going to make payment which is equal to difference between $10 million and the market value of that loan today. Now, because this Danger Corporation is not paying, we will find out how much amount can be recovered from Danger Corporation. Suppose the market value of this bond is only 30%. We think we will not recover more than 30%. So the value of that bond, that is bond issued by Danger Corp, is only 3 million now. Nobody is going to pay you more than 3 million because you are not going to recover more than 3 million. So what is the loss to BB Corp? Please reply. The loss to BB Corp will be 10 minus 3, 7, because the book value is 10, but now this bond or this loan is worth only $3 million. So BB Corp would lose $7 million. So in that case, what they do? They go for cash settlement. This SS Bank will make a payment of $7 million to BB Corp. Correct? This is called cash settlement. Only the differential amount is paid. Difference between $10 million and the market value of the bond today on the date of default will be taken, and $7 million will be paid to BB Corp. That is how cash settlement is done. The formula for cash settlement is par value on the screen at the top minus market value. Par value minus market value. Par value is 10 million, market value is 3 million, 7 million will be paid to the protection buyer BB Corp. Is it right? So this was easy cash settlement and physical settlement. So I hope you enjoyed this chapter. Very important to make cash settlement more transparent. The credit event auction was developed, which means to calculate that market value on the default date, the amount will be arrived at using auction system. Credit event auction sets a price for all market participants that choose to cash settlement. That means in the credit event auction, they will be able to identify what is the market price in case of cash settlement. One more line you add from my side. Or is it printed? Just let it be, it's not important. So this was the important chapter for theory questions, credit default swap and collateralized debt obligation. So thank you very much.